Okay, so I've been given the go-ahead. We're ready to start, guys. So welcome to this afternoon/evening coaching. Hope we're all very well. Been an exciting day, obviously, in that Euro to an extent with that ECB. And today, hopefully, we're going to learn a little bit of sort of money management and a few tips that you can apply to your own strategy. We're going to be focusing on advanced scaling. For those of you who have not attended before, my name is Jack. I'm a head of trader development at Trademo, and I'm here to give you some of my knowledge from 7 years of trading professionally, institutionally, at a number of prop houses and funds. So we're going to crack on, and as I say, we're looking to trade using advanced scaling in. How many of you guys have ever heard of advanced scaling in? I'm sure you've all heard of scaling in. Maybe someone has heard of it. David, what about you, or Rashir, Mr. C? Have you ever seen the concept before in action, or have any of you actually seen sort of what it's all about? Anyone at all? Because it's a fairly common strategy for sort of more advanced and professional traders. And it is something that I look forward to taking you through. But obviously, before we begin, very, very important that we just start with a standard disclaimer, guys. So spread bet and FX and CFD trading carry a high level of risk to your capital and can result in losses that may exceed the initial deposit. Trading of these products may not be suitable for everyone, so please ensure that you understand all of the risks associated with trading. The information and comments provided herein under no circumstance are to be considered an offer or solicitation to invest, and all information provided is believed to be accurate at the time of production. Nothing herein should be construed as investment advice, and information provided within this room is the personal opinion of the moderator, that's me, Jack, and not Trademo or FX Street. This content, therefore, does not constitute financial, investment, or tax advice, and Trademo and FX Street accepts no liability for the content of or comments made during the session. So, back to advanced scaling in, guys. I've heard more about scaling out. Absolutely. I do scale out a lot, and it is something that is used by traders, both beginner, intermediate, and advanced. Being able to optimize the profit that you take by scaling out of the market is very, very important. But advanced scaling in is also something that a lot of professional traders will use, guys. I can't stress it enough that it is something that I have used for over 7 years in my trading, and it does require a little bit of discipline. Okay, if we actually have a little look at what it means, it is basically entering a position in stages, just like when you are scaling out of a trade, but you exit out in stages. But it is slightly different to the standard practice of scaling in. On a standard chart, when we look to scale into a chart, and let's take this up example here in the dollar yen, what you would look to do is as the trade sort of breaks through our resistance line that we have here, you would look to enter into a trade potentially. Then, as your trade goes on side and maybe pulls back to another small resistance that we can see here, you'd enter into another position. And gradually, as the trade moves, you actually enter into the trade in stages and optimize your potential returns. But advanced scaling is completely different. Advanced scaling requires that you actually enter into a position, and then as the price actually moves against your initial sort of direction that you're looking to trade, you add to that position. Now, it's very, very important to know the difference between advanced scaling and averaging. It's very, very simple to get the two confused, but there are some very strong rules that you have. Now, with advanced scaling, it is something that does require sort of more psychological discipline. Can anyone tell me why that might be the case if you're maybe getting into a trade when it goes against you? Do any of you sort of have any idea of why it might require more psychological discipline than maybe scaling into a position as it moves on side? Absolutely, David, you're completely right. You're technically in a negative position at the time, but another reason it takes more psychological sort of discipline is because obviously of the way human brain is wired. Okay, we're not wired to lose. We don't like to see lose. It's about your comfort zone and stepping outside of it. So a number of different reasons why it is more of an advanced concept. And if we look at the difference, because there is a definite mix-up. A lot of traders say, well, why do you scale in if the trade goes against you? That's just averaging. That's using the martingale system, where you double down. But it's very, very different, because advanced scaling applies certain principles. And those principles we'll take a look at in a second. But the difference is you're never moving out of your money management principles. We've all heard of the 2% rule. We've all heard of the 1% rule. We've all heard that, to keep yourself in the game during periods of downturn, you're supposed to risk a certain amount when you're trading. And that does apply for the advanced scaling in. With an averager, obviously, it's completely different. You will enter your trade for your 2%. And then when it goes offside, you get a bit worried, you have fear of losing. You add in another 2%. And the hope is that your average price here will get traded again. And then if it goes off again, using maybe a martingale system, you'll double down and you'll double down. And your total exposure here would be around 16%. But using advanced scaling, you never go past the sort of money management rules that we're very much taught when we first begin trading. And so it's very, very much a different entity. Okay, guys? So, get the idea of averaging out of your head. It's not about averaging. With certain very basic rules and with certain techniques, you can actually apply advanced scaling very, very simply. Okay, and it will help with your average price that you enter. It will help with your profitability, but getting it right is a bit of an art and it does take time. So if you are going to try it out, guys, you might want to consider. I did it on a demo account for a while when I first started trading because that really helped me to just sort of get to grips with it and find certain techniques. And I'm going to show you some very basic techniques that you can use, using things that we use in everyday trading. So what are the rules? Well, guys, the rules are very simple. First of all, you must have a significant reason to believe the market will continue in its original direction. There's no point just guessing. One of the big things that gamblers will do is they are just guessing that a market is going to go a particular direction. Okay, you need to get that out of your head. You need to generally have at least sort of 2 or 3 reasons to believe that a market will continue in its direction. And I say continue in its original direction because generally speaking, for those of you who have never used advanced scaling before, it is easiest to use in a trending market. The idea is that the trend is your friend. Okay, you can use it for reversal trading, and I will show you a couple of basic techniques for that. But you need to understand that when you first start, this sort of using this, it's psychologically more easy to not go against the market, to go with the market. Okay, another basic rule: your volume should never exceed more than 2% of your account. And generally speaking, traders will limit the amount of positions that they place. Okay, never more than sort of 3 or 4 positions should be used in advanced scaling. I've seen traders, and I'm not lying. I used to sit next to a trader, and he actually had about 29 positions on in a market. Okay, and that was blatantly averaging. There was no way that he had employed money management. And he was actually the first guy I ever sat next to at the prop house I was working at. I'd just gone live. And he basically wiped himself out. So you can see why it's so important, to limit the number of positions you put on and, the amount of risk that you actually have. And the big one, guys, I can't stress this enough. How many of you plan your trades before you put it on? And, the more experienced traders generally plan their trades a lot less. But how many of you guys, FX Boyke, David, Kevin, Milan, David, any of you guys plan your trades in advance? Do you write them down? Absolutely, you do now after hard lessons. And it's very, very important, when you first start with this advanced scaling, that you actually plan the position, because you need to plan exactly where you're going to enter. There's no point coming to a chart and saying to myself, oh, I'm going to, let's pretend we're moving up here. I'm just going to enter at this level and, I might enter here. No, you need to very much have it in place, because money management, you need to know exactly what amount of volume that you are trading will actually, fit into the scaling technique that you're using. So it's good to hear that everyone, plans a trade and it takes out the emotions. We've all been there, David, we've all had the issue, and Rushir, it's something that does take practice, obviously, to do. But, that's part of conditioning. Conditioning is a very, very big part of trading. So just bear in mind, guys, there are some very basic rules that we have here. Okay, so when it comes to advanced scaling, just be aware that there are sort of 2 methods for scaling in and out of your trades. Okay, and generally speaking, you can actually apply this method to your scaling out as well, guys. Okay, there's the aggressive entry and the conservative entry. And basically speaking, I'm more of an aggressive trader in terms of my entry. And generally what will happen is when you put a trade on, your first position is the largest. Okay, what you're looking for is you're looking for a market bounce. Okay, so you're looking for maybe a retracement, and you don't want to miss the trade, because one of the pitfalls of advanced scaling, if you don't employ it in the correct manner, is that actually you can actually miss out on the trade. If we actually have a little look at the chart, we have dollar yen here on the chart, and we can see that we've had a very good up move. The market is clearly trending based on a lot of fundamentals in the market. Actually, we have come up from about sort of 70 level. Okay, so we come up in the market at this point. There's talk, there's rhetoric, the fundamentals, everything dictates that we should be moving up to sort of 110. So for me, and this is an actual trade that I've taken, I look for a pullback. Now, we can see quite clearly on the chart that there are a couple of sort of areas that we should be interested in. At this sort of juncture here, if we just move this out of the way, we can see, we've got a bit of a head and shoulders, but this double top is a good support level. As well as this, on the daily, we can see we've got this 101 sort of 20 area, and ultimately the 154 is a very interesting entry level for us. So when it comes to advanced scaling, and obviously we're looking at this in a more long-term manner, okay, the aggressive trader, what they will do is they will generally enter sort of around 50% of their trade on the first entry. Okay, and the reason that they do that is because the aggressive trader is trying to get on that move before it carries on going. Now, what do you think is the danger of that, guys? Like being aggressive. What do you think is one of the things we need to be careful of when it comes to entering aggressively? What do you think, guys? Rashir or David, Kevin? What do you think, guys? Andras or Bernard, nice to see you. It could still dip, absolutely. So, it's not very good if you've got half of your trade on at this level and it pulls all the way down to our two other support levels. We're clearly in a trend, guys. Zooming out of the dollar yen, we're in the trend. We have a reason to believe that trend's going to continue. But the issue is, by putting your 50% on here, okay, it's going to take psychological willpower, guys. Okay, because, you could see a move down to these sort of levels, which means at this point, you're, 150 to 200 pips offside. And yeah, absolutely, Rashid, this is the hard thing about it. You might get out of that trade, okay? And it's also worth bearing in mind that if you enter into half of your trade here, and then sort of at this level, second level, you enter into sort of 25% of your trade, and another 25% at this sort of red line here. Let's just plonk that there for now. Okay, the issue is that your average price, okay, is not actually going to be right in the middle. It is going to be slightly higher because you've entered most of your position. Do I trail my stops? It's a very, very good point, Boykin. We'll talk about how I trail my stops when we talk about one of the particular methods that I use, which is a moving average method, towards the end of the session, mate. How does that sound? It's very important to trail stops, in my opinion, and again, it's just my opinion. So, guys, as I was saying, your aggressive method, you're very much limiting your entry to, your average position entry is probably going to be up here. Whereas, if you apply a more conservative method, you're going to have a better entry level. And let me just, there we go, move this out of the way. So popping back, that's the aggressive method, okay? And it's the method that I generally will employ. Once the aggressive method has been undertaken and you take it for the first time, your further entries are smaller. Some people will use a 25%, 25% after that initial 50%. Some will use a 50%, a 10%, a 10%. It does depend on how many levels you have on the chart. And remember, in our last session, we talked about grading levels when we talked about discretionary trading with red, purple, and orange. So, you can obviously bring that into the fold. A conservative entry, as we already know, guys, is what? What do we think a conservative entry is going to be like, guys? If an aggressive one is our first position, adds a lot. Yeah, absolutely. You can see this here in front of you. The volume is generally the same. It's standard to scaling in to a general trade when, you're using standard scaling. When, you buy a trade and it moves on the side, you buy pretty much the same amount or less, carries on, buys a bit more, maybe a bit less, and carries on going. Well, this is a similar method. Okay, instead of employing that method of risking, a 50%, which is a lot, to risk on one trade, what we do is we enter sort of 25% at this level, And then obviously, if you're scaling in at 3 positions, you would enter, the remaining 75% over the 2 positions. So, it'd be about 30%. And generally, another rule, guys, if you are just using 3 positions and not 4 positions, it's an odd number. What I will do is, instead of, risking 25%, and then we've got 75% of our trade to put on, so that would be 37.5%. What I will do is I'll just enter maybe 25% and 25%. It's all about keeping your money management, guys, and keeping, yourself in the game. So basically, your conservative trader will add 25 and 25. Now, the good thing about that is that would bring our average to pretty much, a nice fair level. In fact, if you were to add 37.5% to both of these trades and 25%, your average would be much lower. It would be a much better price. However, guys, what's the pitfall of that? What do we think? If, we get a bit of a retracement down, and let's pretend that we're trading sort of here in the market, and we get our first trade on, and then we see this bounce, what's the danger of it, guys? What do we think? Very, very simple one for us to answer, guys. A few easy questions to look at. Absolutely. We bounce higher and we end up with less of the position on. But, it's not bad if you have a winner. You never go broke taking a winner, guys. That's a bit of advice that I was given when I first started trading. So let's move these out of the way and let's pop back to the slideshow. What we're going to do now is we're going to have a little look at sort of how you can identify the retracements. There's a few different methods for doing this. And generally speaking, when it comes to entering using these different methods, we're looking for trend following tools, guys. We're looking for things that give us a pull through. A couple of examples. I'm gonna take you through just about 3 or 4 of the basic principles that I use. But generally, we need to be identifying retracements, and the best way to do that, guys, is by in effect using trend tools. So let's have a little look at an oil chart. Okay. And we can see straight away, that we are pretty much in a little bit of an uptrend. We pulled back, and if we actually have a little look at what oil has done, it's in a big range. Okay, so we'll take it down and see if we can find a trend in market. Because again, when you're using advanced scaling in a range in market, it's generally not going to work well because the market will move sideways. So let's have a little example. There we are. We've got a little bit of an uptrend in oil. We can see it quite clearly here. Okay, so when it comes to identifying a trend, things like ADX work very well, I found. This is the first thing we need to be able to do. We need to identify that trend. I generally will use the ADX, but you'll notice that I don't use the D plus and D1 lines, and you'll notice that I have a 20-25 handle. So what I will do is I will identify when price begins to tick above that 25 level. Okay, and that tells me at this point where we find ourselves between here and here, we're quite clearly in a range in market. We can see that, by the fact that we've got very small candles, volumes very low, and, there are RSIs in the middle of the chart. But, as soon as we begin to tick up, we can see that we break a resistance level. Okay, and so when it comes to sort of looking for a breakout trade, okay, ADX very, very good for identifying the trends. As well as that, guys, very, very simple things like moving average. What do you guys use to identify a trend potentially? How do you guys, if trending risk should be nil as it goes on its way? Higher highs and higher lows, says Joe. FX Boyke, just repeat that. Sorry, what do you mean? Your risk should be 0 in all fairness. So I can see that David uses a 5 and 8 simple moving average and an EMA exponential cross for trailing the stop. Absolutely, we'll show you methods for trailing out potentially FX Boyke. Ichimoku is the trend, not something that I particularly am fond of, but that's why trading's so good. Everyone's an individual. And I can see that Ray uses moving averages. So yeah, basically, guys, higher highs, higher lows on a move up. Fibonacci is also a good one. We're looking for things where we can identify the trend. So, you will have this already in your system. Now, I like to use volume is a big gauge for me. I talk about volume all the time. It's the big gauge for me because generally speaking, when we're in a range of market, we see low volume. We look to see what happens when we break, and we're looking for sort of spikes in volume. We can see that we break our little bit of a resistance that we have in this sort of area. and we do it with very, very good volume. Okay, so volume is another one that I like to use to be able to find the trend. Once I've decided that I'm going to scale into a trade, and there are lots and lots of methods, guys. So moving on. Okay, from that, let's have a little look at what it looks like, how we potentially scale in, shall we? Okay, so you all have your way. Volume is relative to your views, absolutely, Joe, but, generally, think about the sort of herd mentality and the mentality of trading. When we break a level, there's stops, and generally the shape of the candle will help confirm things. Never use volume on its own, but generally if we have a big move up on low volume, it's not a good sign for me. So moving on, okay, easiest way to really enter into the trade, as I say, commonly used ratios below. Okay, we've got a nice little example on the chart. Okay, we have a little break higher, okay, on the chart. Now we begin to move into a trend on this example. It's actually the Aussie dollar on a daily from a couple of years ago. It's when I traded. Okay, and we can see that we get a bit of a hanging man, and we begin to form a little bit of an intermediate support level. Okay, now when we enter into a trend, very much what I like to do is I like to try and preempt consolidation patterns. If we actually have a little look at the New Zealand dollar before it had its big break low down, you can see that we had this big trend, we moved up, and then you could see we began to form this consolidation pattern that we're still technically within now. Okay, so I like to try and preempt early that a trend's going to continue and find intermediate sort of support areas to get in. And in our example on our side, that's exactly what we have. Okay, we have sort of an intermediate resistance and a support, not a massive one. So for this method, guys, what do you reckon? Would you use an aggressive, conservative, or ultra conservative ratio where you enter into sort of very much smaller amounts and then bigger amounts as you come towards key levels? What do you reckon? What one would you use? I mean, if it was me, I'd probably stick with a conservative because I'm confident the market's going to go higher. But, do you think ultra conservatives may be the one? Yeah, well, I think you're right, David. And again, does anyone disagree? Is there anyone who'd be ultra aggressive? Because there's not necessarily a right or wrong answer. I'm just talking from my own experience, obviously, guys. Every trader is different. What are the percentages of? So it's the percentage of how much you enter, FX Boyke. So if you were trading a 2 lot, here you would enter into 1 lot, half a lot, and half a lot, total trade volume. And then obviously half lot, half lot, half lot, half lot, quarter lot, half lot, 1 lot. Okay, but FX Boyke, everything cool there? Okay, so I presume no news. Of the account, no. You never enter 100% of your account into one single trade. Enter at once. It might just be your trading style, Richard. There's not a right and wrong answer. I know people that will literally only enter into one position. I know it for a fact. Guys who have been trading much longer than me just refuse to scale in. 100% of risk. So yeah, basically it's 50% of your risk, 25% of your risk, and 25% of your risk. So if you're risking 2%, you'd risk 1%, 0.5%. Okay, so basically we can see here we have a nice example. We have a little bit of a move down. We've broken into a trend, and there's actually a very good sort of resistance. You can see it in the Aussie if you look at that daily chart, and we can see that we also have a little bit of an intermediate level. Okay, beforehand. So, just picking, these are very small levels. This isn't the greatest example we've seen. There's a really good one in the dollar yen that I'll show you in a second. But basically, you can see at the first position, you would look to maybe re-enter around this area here. Okay, because obviously we get that sort of hammer that forms, forming a nice consolidation. You then see that we have a big move down, but we've already decided that, we've had a big move up already. For us to just pull back a little bit and carry on going would be a tall order, but it does mean, it could happen. Okay, so that's why we're trying to enter into it a little bit earlier. Okay, because we're confident the trend's going to continue, a bit like that New Zealand dollar. So it pulls back, and you can see it comes down to our second entry. Then we get a little bit of a sort of doji, a little bit of a retracement. Generally, after a big incense candle like that, you would have expected to break through this support level. And then we can see that again, we come down to our initial breakout point, and we get a nice hammer. And so we enter into the third position. We can see it comes back, back down, and then continues to move higher into a trend. So you can see it's not for the faint-hearted. You know, if you were long here, some of your trade, you'd be thinking to yourself, oh my days, what is going on? But, you know, it works very well because, you know, instead of entering into all your trade up here, and, you know, we actually have a nice average in the middle. Obviously, if we had entered here, it would be great. But, you know, there's nothing to say that we're not going to move down and then just carry on and not end up with that trade if we've been too patient. Some candlestick patterns can be deceptive, which is why volume oscillators and price action, you need to use sort of, I have a rule, I generally use 2 or 3 reasons, you know, between 2 and 3 is when I'll enter a trade. But, you know, generally 2, 3, 4, or 5 sort of little decision support tools. Generally, I'll use a bit of level 2 data. You know, TT is Trading Technologies, is a DMA. So it's an ECN, basically. It shows you the volume on either side of the market, the depth on either side of the market, and, you know, using CQG. Yeah, absolutely. But you can use it on MetaTrader. I found in extensive tests, guys, because I've been doing it for guys that obviously we give coachings to. It's not a bad method, the volume that you get on MetaTrader from your broker. It's not entirely representative, but it's not a bad volume, guys. Yeah, for Forex, again, you can get that data depending on who you use. For example, I use a thing called Marex Black for my currency, cash currency, and that actually gives you the amount that's traded at every price. So you can actually see the flows as they come through. Yeah, so you can see if someone's iceberging and ordering things. But, you know, even using MetaTrader is very, very simple to use. Things like Market News, MNI, again, you can see where the big orders are in the market. So there are lots and lots of different things. As in, can I pinpoint? Absolutely. Deb, and we'll move on after this. So as a conservative trader, okay, what you would do is you would enter at the same levels as if you were being aggressive. The difference is your risk parameters. Does that make sense to you? It's not about the actual level you enter, okay? Technically speaking, when you're an advanced scaler, you are more aggressive anyway. But it's about the level of risk that you take. So, you know, as I say, if you're risking 1%, you would risk half of that risk, total risk, would be entered in on the first position. If you're ultra conservative, you know, it might just be 10%. It might be 12.5%. So again, we'll have a little look at some examples and maybe try and find some real life examples as well towards the end of the session, guys. So as we can see, you know, price moves against us, it carries on going, which is good because for me, you know, if I'd entered into a trade at this level and it had come down here, I'd probably have exited the trade, guys. Okay, whereas by scaling in, it keeps me in that trade a little bit longer. So again, we have a short example on the chart, and you can see that, you know, we have a little bit of a support level here that breaks, we break it again, and then it becomes a resistance. Okay, and this area here, we can see that we find it very, very difficult to pinpoint one level. Can you see that, guys? You know, between the orange levels, and this is another reason why scaling in is I think is very good, because prices will not gravitate to just one sort of point on the chart. Oh, excuse me. Prices will actually gravitate to a zone. You know, if we have a little look on the chart now, and have a little look back at, say, that euro on the 3rd minute, we can see, you know, that when we look at our support level that broke today, can you see this 137? You know, the problem you've got is, where do I actually enter into that trade? Because we can see that we have, you know, a support level here. Then we have the resistance close by, so very congested zone. We have another support level, and then, you know, we have the support level here. So generally speaking, you know, on a retest, if we're looking to get short this euro now, where do we enter? Do we enter at this level? Do we enter at this level? Do we enter at this level? You know, it makes it very, very hard if you're trading with one position. I mean, obviously the conservative trader would look here. If you're trading just one position, the aggressive trader would probably look here. But with advanced scaling, you can actually take advantage of this zone, because we know that this euro should be fundamentally weak at the moment, at least. You know, maybe that will change tomorrow with non-farm payrolls. Best time frames to scale in, generally speaking. Multiple time frame analysis is good for your initial entry, but generally speaking, I like to use just a one time frame. It depends. If you're an ultra short term trader, you know, what I will do is I will mark up levels on the chart. So in this euro, for example, we have sort of these levels here that we can see. We have 3 good levels where we could look to maybe enter, enter, and enter. And what I will do is when price gets up to this level, or you know, this level or this level, what we'll do is I will look at a 5-minute chart and just take it down. And the reason I do that is I'm looking for any reason that we're going to reject this level. You know, so I've made up my mind that I'm going to scale into the trade, all going to plan in an optimal situation that is going to move higher. But if price comes up to this level and there's a doji that forms, okay, that could affect, you know, doji forms, we get some volume, maybe the RSI, it won't be, but maybe the RSI is overbought. You know, I've got 2 or 3 reasons to think that we're going to have a down move. Okay, that will actually affect whether I am aggressive, conservative, or ultra conservative. Okay, because if I get a nice doji form here, nice volume, and it looks like we're just going to carry on, I'll put 50% of the trade on. Okay, whereas if, you know, we just get sort of a bit of trading around there, I'll be more conservative. So, you know, the situation, generally 4 time frames is the rule. Okay, guys, so, you know, just like with standard trading, if you're looking at a daily, you can use a 4 hour. If you're looking at a 4 hour, you can look at an hourly. If you're using an hourly, 15 minute, probably 5 minutes, okay, but that's generally what I'm looking at. But, you know, I trade 30-minute daily time frames and occasionally use the 5-minute. It's very noisy, as FX Boyke says. How do you calculate your stop loss? Well, your stop loss is just calculated as you would normally. Okay, so you would work out your risk trade. So basically speaking, a little tip for you is if you want to be more conservative when you first start, work out which is the lowest point. So this area here. So wherever you sort of entering, whether you're entering here or here, work your stop loss out. So, you know, we can see that if we were to pop our stop loss, again, advanced scaling is a tool. It's not just, you know, it's not a whole trading system, guys. It's not a whole strategy that will tell you where to place your stop loss. You will use your existing strategy for your stop loss. And generally what you will do is, let's pretend that we're going to use this swing high. You would say, right, I've got a 50 pip stop there for my trade. So, you know, you take your account denomination and account size, multiply it by the risk you're taking, 0.02 would be 2%, and then take that number. That's how much you're going to risk in cash. And then obviously it's your pip stop, so 55 pips times by that $10 that it's worth per price increment in the euro, and then divide A by B. So that's generally how you how and when do I exit? Well, we're going to get on to that, guys. We're going to push on now because obviously we want to get as much done as we can. Well, that's good. You know, a lot of the DMAs will do your very much your average entry level, but you can split it. So let's pop back anyway. So first way to do it, guys, very easy, support and resistance. This is the one that I first started using when I was scaling in. Risk reward does come into it, absolutely. But again, it should be part of your bigger system, FX Boyke. This is just a tool. These are some tips that you can apply to your existing trading system, or you can build a system around it. So support and resistance, very important. Okay. Generally, it's very, very common because, as I've said, you know, what happens is when we get a nice sort of move up and then we get a support zone, it's not one price. You know, we get a support, there's a support zone here with bodies, but then we have a little bit of a breakdown, but then this is still a support level. We also have, you know, this support level here. And as well as that, technically speaking, we have the swing low of the consolidation pattern that we have. So support and resistance is a very, very nice way to do it. And generally, you know, your stop loss is placed below the very, very low of, you know, your last entry. And how you do that might reflect differently on system to system. Generally, I will calculate it based on one of my systems, which I use a Bollinger Band based system. And I will use sort of 25 pips from top of Bollinger. But it depends on how you trade. You know, I've got another one with price action, which basically takes into account the actual average true range and, you know, the candlestick pattern. Okay, remember, this is a tool to help you scale, you know, scaling in, advanced scaling in. It's not a specific strategy. Next coaching, I'm going to give you a couple of strategies you can actually try and trade yourselves. So support and resistance, very, very good. There's been an all right example, if I do say so myself, in this dollar yen. Again, we pop back to this. we can see quite clearly that there is on the move higher that we have had on the chart, guys. Again, I'm very, very bullish dollar yen longer term. Okay, we can see that, we have a bit of a resistance zone here. And again, we're using the bodies, not just the wicks. Okay, and we can see the high here. So it's around this 103.19. Okay, and we get a bit of a bounce. Okay, but at the same time, I'm thinking to myself, this RSI is overbought. My sentiment is I think we probably will have a correction. Let's have a little look at the Fibonacci. We can see 100% retracement down here, but a 30%, 40% is between this area here. So, it would be very easy for us to move lower. So I think to myself, I don't think I'm very confident buying a market that has rallied. It's already rallied 30 or 40 points, and it's only come off 200. I'm thinking it could have a bigger correction. So at this point, I decide I'm going to enter some of the trade at our level here, and I am looking for, that 110 level. Okay, so again, risk reward comes into it. If you're only looking for a short-term risk reward, you might want to decide to, very much just looking for, the average true range, in this case, 70 pips. If you're only looking for a quick 70 pip bounce, then, you might want to decide to just enter all of that trade. Okay, so I do prefer it with a longer term trade in myself, guys, as well. Bear that in mind. So we carry on, we move down. Okay, and then we already know that this is a crucial support pivot. We can see it on the daily that it's been a very, very good level. So we enter into a little bit more of the trade. And the reason we use zones, okay, and the reason we use more than one position is, this level here still goes 50 or 60 pips offside. So there's no guarantee that we're going to pick the perfect level, which is why we look to get in smaller amounts to try and bring our average, instead of it being up here, or instead of it, if you're being more conservative and waiting for a bigger bounce, instead of it being here, by entering at sort of the two levels, this area here and this area, which we know is a resistance zone, you bring your average down and give yourself a much better opportunity for holding the trade. Draghi can mess up a trade. You're absolutely right, Boyke. He's done a few of mine in the past. Okay, and then we see, come back to the level we're in, probably two lots of our trade, okay, or one lot of our trade. We haven't been filled. That's one of the pitfalls, guys. You might not have been filled on this level. And then we continue to move higher. But a little tip for you guys, what you can do is if you enter into a trade using support and resistance or Fibonacci, what I will do is, let's say we want to enter into 3 positions. Okay, and the market is trading here like this. Okay, what you can say to yourself is, we move down, we get filled here, we buy some of our 50%, we buy another 25% here. We don't get filled on this very last amount, do we? Price bounces up. So what you can do, a little rule, is your initial entry, the price where your initial entry took place. Okay, look to, when we close back above there, or we get a break back above there, you can actually enter into the trade again. Okay, or when we break back above the level, if we retest, your initial entry level, you look to enter in to the part of the trade that you have missed. So we can see that we're long here and here. We've broken back above the level. And again, it's if you have a reason. So, we have a nice candlestick bounce there. So on that candle, I'd probably pull that average and I'll just put the rest of the trade on there. And I'd be happy that my average position is in the middle. And then we can see, we continue to move sideways for a while, and then eventually we move up. Okay, guys? So that's a little tip for you. If you don't get filled on a position, you can do it as we retrace back through, because hopefully we're in a trend. So another method we can use, guys, quickly moving on. Candlestick patterns, easiest one in the world. One of the biggest things I will use are candlestick patterns. How many of you guys trade, things like hammers and dojis? How many of you guys will use hammers and dojis? Absolutely, right, fine. So for me, we can see that we have our shooting star here, okay? A lot of traders will just enter into a position, okay? It's good. We have a nice resistance. RSI sort of diverged a little bit, which is good, telling us, good volume on this candle, telling us we can get short, okay? Most people will enter into a trade here. What I do is I do it slightly different. I will enter into a certain amount of my position on the open of this candle, but then I will look to get into the trade using something like Fibonacci, and enter at sort of the 38.2, the 50%, and the 23.6, or I will scale in at these levels, 33% of this candle and 66% of this candle, because again, basically speaking, if we think the market's going to move lower, why are we entering it potentially, on the open? Very rarely will a market just go straight line. It will pull back first. So by doing that, we give ourselves a better entry level, okay? And it helps with our risk reward. So generally speaking, look for the scale, okay? And we're going to show you how you can combine these in a second. When it comes to scaling in, again, remember 2 or 3 positions is sort of the average, but for as many as 4 is allowed. And then Fibonacci, guys. Fibonacci is another one that we can use, okay? And this works very well, I find, with candlestick analysis. We can see we have a big up move. We can see that we have a Fibonacci at 38.2 and that 50%, okay? And at this point, we can see that, we get a nice hammer. So we'd probably enter into the, obviously, the rest of our trade if we weren't already in. A normal trader would enter maybe at this point, okay? However, if you scaled in, you may have entered at the 38.2% of the move and the 50% of the move, and that gives you an average much, much lower and helps, when the market moves on side. And combining them, guys, is a very, very good way. I've just shown you what, this retracement. If we actually zoom in, okay, onto this area here and have a little look at the chart. And again, oopsie daisy, I appear to have lost that one. Let me just zoom out to find it. There we go. So let's back in. Me being clumsy again, guys. Okay, good. So, what I like to do, combine it. We have a candlestick pattern. Pull up a Fibonacci, guys. This is something I always use. Look at a Fibonacci of that candle, and it's not easy to see. So you've got to keep your wits about you. Okay. And you can see that in this case, we do go through the 62.8, but your stop loss always goes above the high anyway with these shooting stars, and we scale in at certain levels. I can't tell you the amount of times when, we've actually had some pretty good examples of, the market retracing, the trading room that I'm very active in. There were a few examples today, actually, that were amazing, very, very amazing. So, combine the two, guys. Fibonacci and candlestick patterns is a particular favorite of mine. Now, how do you manage your risk? How do you scale out of the trade? Well, we will do a coaching on scaling out, but generally speaking, guys, what I will do with candlestick analysis after I've scaled into a trade is very simple. Once I move back through that initial position, okay, I move my stop loss above the second position. So if we have 3 positions in the market like this, okay, what I will do with candlestick analysis is as soon as price moves back below this, that stop loss gets moved down to just above the level. As soon as we move back through this price, okay, I will generally leave it for at least 1 candle. And depending on what that candle does, very, very much, I will move it down afterwards. Okay, but generally speaking, again, you will have your own method for trailing out. This is about getting into the trades at the moment, guys. Okay, the worst thing you can do though is sell it here, and sell it here. And then, once we get filled at this price, a lot of traders actually will do this. They will say, well, I'm short here and here, and this is a break even. I'll get out. Okay, and I'll leave the 2. Or even worse, you've got to make sure you don't do that, guys. So, another good way of scaling out, obviously the triple moving average. I like to use a 30, 60, and 120, guys. Okay, bear this in mind. Is intranet each retracement in a trend? Absolutely. Absolutely. That's the whole point. You're looking for a trending market. You're looking for pullbacks to get in. So, retracement levels, very, very much. It is about trading the trend or even maybe trading reversals if you're feeling more advanced. Right, guys, final one, moving average, very, very good way of doing things. Okay, a 30, a 60, and a 120 is what I use. And generally, it's very easy. If I identify a trend, I'll look to see if there's maybe a support level. We can support level that was a recent tier. Okay, so I've got my 30, 60, and 120. I'll look to enter some of the trade and some of the trade here. Now, we can see that I don't get filled on the third amount, but what that means is you can either just leave the 2 positions on here and here, Or what you can actually do is, as we cross back through the first position or through the moving average, you can look to enter the rest of that trade. And we can see, again, it works quite well. If you were looking to, buy again, we didn't get in here, we were looking to buy here. We can buy it here, we pull back, we buy it here, we break higher. And again, we pull higher, we pull back, 1, 2, 3 positions, market goes onside our averages in the middle. Okay, and a good thing is with the moving averages, it gives you levels for your stop loss. I will generally track my stop loss once I'm in the whole trade. So let's say that we're in the 2 levels here, it just goes below the slow moving average. Okay, and in this example, obviously, we haven't got all 3 positions on until this point. In this point, because we've only got 2 positions, what you do is you wait for it to break back above this individual moving average, guys, convincingly, and close above before you obviously start trailing it on the low there. On a 3 example, it's very, very simple. Again, we get filled once, we get filled twice, we get filled 3rd time. We keep our stop loss wherever that stop loss may be. Maybe it's below the moving average. Okay, I'd have it below the swing low here. Okay, then as soon as we break back above the last level, the first level we entered, the stop loss just trails either this level or, if you're feeling conservative, this level here. Okay, guys, so, that is a few very, very simple tips for advanced scaling. Any questions? Which line is for the first position? It would be this one. So we move up, we can see we pull back, we enter into the trade. We looking at the market here, we pull back, and we basically enter around those moving averages. In the first entry, well, the first entry would be that it's the stop loss for the whole trade. So your first entry is here. You would have already worked your stop loss out. Now, I will generally track it below this moving average, quite a bit below the moving average, until I've got all 3. Once all 3 trades are on, I will look to move it up quite quickly. But, your stop loss for the first lot would be here. Generally speaking, you should have buy order, buy order, buy order, stop loss for everything below, so that you know that the distance from here to here is 2%. Right, guys, it is wide, but it depends on your trading style. Again, on a 5-minute chart, is it really that wide? It depends. If you're a scalper, you can't really scale in. This is more for trading today, swing trading, things like this. Intraday, guys, anything scalping to swing trading to, I've had a gold trade now for a year working short. This here is obviously not even, 1 day in the market. And you can see, I enter the trade here, it moves up. It's not really that wide. It depends on the time frame you're using. Right, guys, anyway, pretty much at the end of the session. Any more questions before we crack on and conclude the session with a couple of things? Anything at all, guys? Any questions? Okay, good. I'll take silence as being strong as silent. Thanks ever so much. I'll have to talk to FX Street about that. I'll see what I can do for you, Kevin. Okay, see what we can do. With regards to obviously this session's been bought in conjunction with FX Street and Trade at Trademo. This is where you'll find me most of the time, guys, in our trading classroom. Again, we do have a number of professional traders. You'll recognise Dale Pinkett. And we go through a lot of live trading, a lot of things in the sessions. Okay, you can sign up, guys. You can do 1 or 2 things. Obviously, if you trade through Trademo, you can earn Trademo points and access this all free of charge. We have actually just brought in a new subscription system. So, for a fixed amount of points, or for those in America who can't sign up necessarily with a broker, you can obviously buy certain statuses, and with certain statuses, you get access. However, if you are looking to get this for free, very easy, sign up. We've got a number of brokers there. You earn Trademo points as soon as you trade. As many trades as you put on, you earn Trademo points, and you can access things like the trading room, number of courses on analysis, things like scalping courses, lots and lots of cool things on there, guys. And again, if you want to pop by and say hi, we do have a 7-day trial available for everyone. There's the schedule, guys. I'll leave that up for you, and hopefully I'll see some of you in the trading room. I'd like to thank, obviously, you all for attending. We can incorporate Elliott Wave into this, Rashir. Absolutely. It might be a good one, actually, Elliott Wave, because 5 waves could give you, the three sort of pullback areas you're looking for, the two or three pullback areas you're looking for. So absolutely feel free to do it. Now, guys, I am probably going to love you and leave you. Email. I don't think I'm allowed to give my personal email out, guys, for you, unfortunately. Is that what you meant, Drew? I'll have a word with FX Street, and I'm allowed to give you my email, am I? Is that okay, panelist? You can contact me directly here, guys. I'm just popping it into the box for you now. In fact, a better one is if you give me your emails, guys. I can obviously speak with you guys. But just swing by Trademo. I'm there all the time, guys. You can actually get a free trial to the room, no obligation. Literally free 7-day trial. Swing by and say hi. I can put the email. Okay, good. There you go, guys. It's jack.inman@trademo.com. So feel free to send. I wasn't aware. I'm pretty new to FX Street. So send us an email, guys. If you're interested in the slide deck, I can obviously forward it on to you. Thank you ever so much for attending. I'm going to shoot now because I think we've run over a little bit. Have a lovely, lovely evening, and I look forward to seeing you on the 11th in my next session, guys. See you later.